Hello, everyone. Hello. My name is Kobe Cornell Boone. I am managing director and founder of Boone Capital. We are a Reg D 506C private equity firm focused in real assets such as land, timber, ranches, and all the wonderful things that come with recreation and the outdoors. Today, I'm really excited about this video. And as you can see, got a couple of meetings today, so I got the jacket behind me and got the suit on today. But I want to talk about a big boy topic. Big boy topic. A few months ago, one of my mentors, amazing man in Christ, great friend Chris Dennis, um, super successful businessman in the commercial real estate as well as residential space here in Charlotte, North Carolina. We were having a conversation about after Bible study. We are talking about 1031 exchanges. We are talking about land. We are talking about real assets. He's from the South. I'm from North Carolina. He's from South Carolina. Just having a wonderful conversation. I hope he watches this video. And he was telling me, he's like, man, there's some major tailwinds that are coming in the 1031 space. And what you're doing is perfectly positioned to be able to be at a strategic advantage. And I wasn't as aware at that particular time, in all fairness, of 1031 exchanges outside of your intermediary, somebody who's looking to move from one asset to another, if you will. I looked into it on one of our rental properties that we had, still have, and that was about it. Well, I will say I had a conversation yesterday with a wealth strategist that totally enlightened me and a lot of context that my good friend at Bible study shared with me months ago, probably almost a year ago, guys, started to come true. So, what I want to talk to you guys about today is what's happening with the maturity of some of these mortgage loans and debt, and what I kind of see as far as tailwinds that are coming to play. Let's start with a few facts. So, fact number one, and this is coming directly from NBA, you can go and look this up.com. So, according to the Mortgage Bankers Association, approximately $957 billion of commercial and multifamily mortgage debt, you guys, matured in 2025. And that represented roughly 20% of outstanding commercial mortgages. So, recap, nearly $1 trillion of commercial mortgage debt matured in 2025. We're talking post pandemic, right? Second point, they also stated that 875 billion of commercial mortgage debt is scheduled to mature in 2026. Right? So first wave, 957 billion back in 2025. 2026, estimating 875 billion of that is going to actually mature. It's another massive wave, if you will. That's another huge tailwind. Commercial loans are different from residential loans in that commercial real estate is frequently financed with shorter term debt structures that require refinancing at their maturity. What does that mean? In so many words, you're creating reoccurring refinancing risk, creating reoccurring refinancing risk. This is why maturity volumes matter. Another key point that I want to share before I get into the discussion is 1031 exchanges have strict deadlines. That is one thing that I knew personally as we were looking at that as an opportunity for ourselves into a larger property, which is that under IRS rules, investors generally have 45 days to identify a replacement property, 180 days to complete the exchange. And to miss those deadlines, um, that can be kind of quite a challenge for folks. So you don't want to miss those deadlines, and the exchange may fail to qualify for its tax deferral if doing so. And I pulled that directly from instructions from Form 8824, 2025 from the IRS.gov website. Last point that I want to touch here is that capital must find a home. Capital must find a home. When investors sell appreciated real estate and pursue a 1031 exchange, they must face a relatively short timeline, if you will, to allocate to redeploy that capital into a replacement property. So, in so many words, what does that mean? Why is that relevant here? what is the meat and potatoes that we want to talk about here? So I have a little bit of a script that I want to share because this is a pretty heavy topic, if you will, and it's not like our regular content when we talk about land. However, the great refinance, if you will, as I'm calling it, is not a prediction. It's not speculative. It's just happening. And to simply understand it is really how commercial real estate financing works. And once you do understand this, you'll start seeing opportunities that most people completely miss. So let's take this for example. Most commercial real estate is not financed the way your primary residence is financed. So your primary home, if you will. If you buy a home, many borrowers are buying. In most cases, myself, most folks are doing a 30-year fixed mortgage, if you will. I know there's some crazy stuff out there, 50-year mortgages, people talking about that, but most folks are doing a 30-year fixed mortgage. Commercial real estate is different. Office buildings, apartment complexes, industrial properties, your shopping centers, your strip malls, if you will. Many of those assets are financed with loans that mature in either 3 years, 6 years, I'm sorry, not 6 years, 5 years, 7 years, or 10 years. So think about what happened with 2025, 900 billion maturity. What happened in 2020? Pandemic, right? Quite a few folks that refinanced their whole portfolio during that time period. So 7 years and then 10 years. And at some point, those loans come due, right? And when they come due, owners must refinance, sell, contribute additional equity, or restructure their debt. Now, think about what happened again back in 2020 and 2022. Capital was abundant, money was flowing, they were printing, money was cheap, interest rates weren't as high as they are now. Um, Investors were buying assets, a lot more aggressively during this time. Developers are building aggressively. We're seeing apartments, townhomes, everything just thrown up, right? Lenders were financing aggressively as well, and many of those owners locked in loans during that period. And we're even seeing folks now who got that low interest rate, right? And they're like, "Hey, I'm not moving. Huh. I'm staying here, or I'm not moving to a new building. Like I'm staying where I'm at." However, here's the issue: those loans are approaching maturity. We have a saying down here in the South, which is that the chickens are coming to roost. The environment today looks very different. Interest rates are higher, right? Everybody knows that interest rates are higher. Some of those properties that made sense at 3%, debt may not look as attractive at 6%, 7%, or even higher. So for some owners, refinancing will be manageable, right? Like for others, it creates more pressure. Not necessarily distress, which I want to make sure that I hit on. It's not necessarily distress per se, but pressure either to sell, to recapitalize, pressure to look at exploring with partners, or pressure to find liquidity. And this is where the opportunity, if you will, often emerges, not because the economy is collapsing, not because the sky is falling, so to speak, but because capital has to move. It's a flow, it has to move. And whenever capital has to move, opportunities are created, for folks like us who are in a land space in general as a private equity firm. Now, let's talk a little bit about 1031 exchanges. So, a lot of people hear the term, but they don't fully understand it. And that was me for sure months ago. And I thank him so much for taking that time to speak with me. A 1031 exchange is a tax deferral strategy, if you will, that allows an investor to sell certain investment real estate and reinvest into another qualifying property. I think the word's been used, I've heard it used before, like kind property, but um, really just another qualifying property. The investor defers capital gains taxes rather than recognizing them immediately. So instead of realizing it immediately, they're actually deferring those capital gain taxes. But there are strict deadlines, as I mentioned earlier. You got 45 days to identify a replacement property, 180 days to close, and those deadlines, they matter. Now, because one property sells, the clock starts ticking. Rather, once a property sells, the clock starts ticking. Investors don't want to miss those deadlines. Again, this is not something that you want to get behind on at all. So they begin searching for those replacement opportunities early on. So think about that. For example, an investor sells a property. They now have a deadline, 45 days, find another property. They need another asset. They need another opportunity. They need somewhere for that capital realized from that one property to go. That capital doesn't always stay in the same asset class, right? Doesn't per se stay in the same asset class. Sometimes it moves, sometimes it shifts, sometimes it leaves one sector entirely and enters another. That's one of the reasons why I would say, in this sense, I spend so much time studying who are the actual buyers of land. We have four exit strategies for our properties. One is your direct buyer. That's going to be a recreational use buyer who's looking to either build a home on their property, hunt what's called the back 40, as we say in the South, enjoy that property for generations with him and his family. Two is going to be a conservation partner. So I'm heavily in conversations with Texas Parks and Wildlife, more specifically in Texas, but Texas Land Council, Texas Land Trust, several different conservation or organization groups where sometimes the highest and best use for a piece of property might actually be repositioning it to be useful for public access, if you will. The third being that, hey, every property is not going to go in the need for conservation easement. Sometimes there are needs in certain parcels for development, right? There's highest and best use when it comes from a residential or multi-use, multi mixed use property, for example. So that would be more of your development play. And in cases where we talk about water, right, water rights are going to be a huge discussion. It already is in certain parts, but a huge discussion definitely in the coming years. So when we look at mitigation banking, water quality control, working here in North Carolina with the North Carolina Department of Environmental Quality, know some great folks over there when it comes to that type of protection work. How can we position that property there? But what I'm saying in so many words is finding out what highest and best use is for that piece of property and the right theme is so important for understanding where it sits as an asset class for that end user. So again, what I really want to make sure that you folks take away from this call today is I'm watching liquidity events. I'm looking at the refinancing activity that was initially not on our radar, but it's coming up more and more in some of the conversations with family offices and high net worth individuals we're having conversations with. I'm watching those liquidity events again and seeing where these billions of dollars may be forced to move. And I'm saying forced to move very respectfully, but forced to move because of the deadlines in place for the maturity of this debt that's taking place right now. So again, as a closing statement, if you will, something I want to share is that nobody knows, right? I don't know exactly where the capital is going to go, and nobody does. But I do know that nearly $1 trillion of commercial debt matured in 2025. That's a fact. Hundreds of billions are of more dollars are scheduled to mature in 2026. That's a fact. Investors who are using 1031 exchanges continue to face these strict deadlines for redeploying that capital. And my job as a fund manager, as an early stage founder in this space and presenting the right opportunities for these investors is to understand where that capital may be looking for opportunities before everyone else is talking about it, and being able to leverage the tailwinds that we're seeing in the land, recreation, conservation, mitigation space, if you will, and being able to present opportunities for tax aware assets that could possibly pass through when we talk about K1s for your LP structure. So, again, a couple of references that I want to share from today's video. I know this was a little bit more meat potatoes, but Mortgage Bankers Association, you can look them up, commercial real estate loan maturity volumes. Literally IRS.gov, IRS section 1031 guidance and form 8824 instructions, Mortgage Bankers Association commercial mortgage debt data as well. And my goal of this video is, some of our videos, we talk a little bit about recreation. We talk about the current property that we're looking to acquire now, which is 356 acres, smack in the middle of Dallas, Texas. It was a former sand and gravel quarry mine. Beautiful piece of property. One of the adjacent properties is actually going to become a park. Had a conversation yesterday with Dallas Green Space. So pretty excited about what we're able to position ourselves to do for folks who are looking at impact investing, ecological impact, how to not just numbers on the screen, but real tangible assets. When you see John Gray from Blackstone say that they're moving in this next quarter into real assets, that's the world that we want to be in, is in a world where we're able to provide an alternative investment for folks who are looking for something a little bit different than their traditional investment class, and something that they can see, touch, feel, and enjoy with their families and loved ones as well. Actually, I'll wrap up this video and say this. I was talking to one of our partners recently, and he mentioned on this particular property being able to see a 4 pound striped bass that was swimming almost 20 feet down because of the quality of the water. And that's the kind of experiences, man, that we're able to offer our potential LPs and folks, is the opportunity to not only invest in something that you get your quarterly email, you get your yearly K1s, whatever the case may be, and you kind of forget about it if you want, unless something goes wrong, God forbid. But we're able to provide something that is an active living, if you will, asset class that folks get to enjoy and love with their families too. So if you enjoy this type of video, if this jams with you, feel free to schedule a call, boomcapital.co. We could talk a little bit more. We are, for this fund, accredited investors only underneath 506C. If you're interested in what we're doing, we'd love to have a phone call. And until next time, God bless you all. Take care.